Hi, good morning. This is Mayor Valensky with Driving Markets. Okay, people are saying I'm too close to the camera, too far away from the camera. So anyhow, let's kick off. Right, Friday, personal consumptions expenditure, the PCE, which is the most favored measure of inflation by the US Federal Reserve, came in much lower than expected. In other words, inflation is on the way down in the US according to this number, which is great. That is great for housing, it's great for the economy, and there's less pressure on the Fed to raise rates. And that's what's likely to happen. There's going to be less pressure on the US Fed to raise rates at the next meeting because they're viewing inflation coming down under control. However, this is not a doom and gloom channel, as many viewers or some viewers are saying it's all doom and gloom. It's not true. I'm giving some hard facts, and those hard facts sometimes involve a little bit of pain. So take that into account when viewing Driving Markets, okay? It's not doom and gloom. It's just a matter of these are the facts. Now, full employment. There's been over 823,000 jobs created in the US this year so far in the first 3 months. That is a huge number of jobs that's being created. And what that is going to create is wage inflation. So remember, I've been saying last year, you're going to have commodity price inflation, energy price inflation, food-driven inflation. What you're going to have in 2023 is wage inflation. So all of those individuals that are thinking that inflation is under control, yes, it is on the consumer side, but not under the wage side. And that is going to really concern the Fed because full employment leads to higher wages. Quite simple. When there is a demand for labor and there's not enough supply, then the price of labor is going to go up. And that's what's happening or likely to happen in the US, in Europe, and in the UK. So you're going to have wage inflation, and that is going to put pressure on the Fed to raise rates. However, there is still this lingering banking crisis going on. On Friday, secondary tier banks or regional banks fell sharply. There is a concern and a fear out there that more banks are going to fall. My personal opinion is that more regional banks are going to fall. Not doom and gloom, just a fact. Now, the question is, will there be a tier 1 bank that will fall? Remember, I have said recently regarding Deutsche Bank and BNP Paribas. At the moment, they've gone a little bit quiet. But I don't believe that the banking crisis that we've experienced over the last couple of weeks or 3 weeks is over. There's probably more out there. And what's likely to happen is there'll be more mergers and acquisitions within the banking sector. So the actual marketplace will shrink. That won't be particularly good for competition, but it is impacting the banking sector. As rates don't rise, or as rates will not rise if there is a crisis, because the Fed would be concerned that they're going to put too much economic stress on the overall economy in the US and globally, then you're going to have all the big shares, the big mega shares will rise. Things like the Apple, the Googles, the Salesforce, CRMs, Meta, who I missed out, Netflix, I don't know, whatever. All those big mega companies will rise if rates don't go higher because they benefit from a low interest rate environment. So keep an eye on the high tech. Now, what's happened over the last week or so, or 2 weeks or so, is that the markets have gone into a relief rally mode. By going to relief rally mode, that the banking crisis is eased and rates are not going to go up, that's allowed equity markets to go up, and obviously things like the US dollar to come off. Come off means it's gone down. So the US dollar is going to probably show a degree of weakness as long as there's no concern about interest rates rising in the US. If interest rates do rise, or there is fear of rising interest rates in the US, then you see the dollar to climb back up. So those of you who are FX or Forex traders, then you can expect more strength on the euro dollar, so more strength on the euro and more strength on the pound, with a rising pound, rising euro. You ain't going to get much strength in the Japanese yen, but you could have more strength in the Aussie dollar and the Canadian dollar against the US dollar going forward. So that's an interesting one for those of you who are FX traders. I see the weakness, dollar weakness, over the next few months. Again, if interest rate environment does not change. Talking about crypto is a big popular one. So crypto's Bitcoin looks like it wants to push itself up to the 29,000-30,000 level. If it breaks through that, then you can see it going all the way to 35,000, which will be the next major resistance level as far as Bitcoin is concerned. Interestingly enough, Bitcoin has gone up in light of the banking crisis, because there's an overall view that maybe this is the now time of the cryptos and Bitcoin to replace the bank payment system. And there's been a lot of popularity in Bitcoin and in the crypto sector. Gold's an interesting one. I could see gold rising all the way to $2,000 or $2,100 an ounce. It looks like gold wants to pierce the $2,000 resistance psychological level. Remember, economics is all about psychology. You have a positive attitude and you go out there, the economy's going to do well. You have a negative attitude, the economy is going to be self-perpetuating situation. You're going to bring it into a negative. So it's not doom and gloom. I'm very positive, but I just want to put some facts on the line for those traders who are equity traders and commodity traders. Oil likely to go up because OPEC and the Russians are likely to cut production in order to maintain the price of oil at a higher level. So you can expect oil to rise over the summer months. Hopefully you're keeping well. This is Mayor Valensky with Driving Markets. Have a good day.